Hey everybody, Nathan Ronen, CFA here with an update primarily for Level 1 candidates, but Level 2 candidates can listen in as well, and I don't think this is too applicable to the Level 3 exam. But if you want to listen in, you can listen in and always learn something. I get a lot of questions on a daily basis, and sometimes when I get the same repetitive question because it's a little bit confusing in the readings or in the practice questions, I'm happy to share these with you in a small, brief, video that I'm posting to social media. If you care to receive these on a continuous basis, as I post them on a weekly or bi-weekly basis, just press the subscribe button and the notifications bell, and you'll be up to date on what's going on in the CFA world. Okay. One of the questions I always get is, Nathan, could you elaborate a little bit more? Because I'm getting confused with the problems that I'm doing about the equity risk premium for an index and the equity risk premium for a stock, and how does that differ from a market risk premium? It's an excellent question because over the years I've seen a lot of confusing problems in the CFA curriculum, both in end of chapter questions or in the blue box, gray box questions within the readings, and sometimes, even from the Q bank that they have, and it serves as a little bit of confusion. But here's how I would basically tackle these questions and not worry too much about them. If you were asked a question on the exam using the capital asset pricing model, so that immediately tells you which model you're using the capital asset pricing model, XYZ companies, the company XYZ companies, cost of equity capital is closest to A, 9.8, B, 10.52, or C, 11.45. You've got yourself a calculation problem there, but you do need to understand the CAPM, because they're going to give you a lot of times on the exam a lot of information, of which much of it you don't even really need to use in order to answer the question. But if you know the components of the CAPM and you know what you need to use to calculate the expected return on the stock, then a lot of the additional information or facts that you're given will easily become, not usable or redundant, and you'll know which pieces of data to use and which ones not. So if we use the capital asset pricing model and we want to come up with the expected return on an individual security or stock, we say that the expected return on the stock is equal to the risk-free rate plus the beta of that stock times the return on the market minus the risk-free rate. So that difference in parentheses, the return of the market minus the risk-free rate, that is called the market risk premium. So everything is looked at as the difference between the return on a developed markets index and the bond market. So a comparison between the stock market in a developed country and its risk-free rate, which is a proxy for the fixed income markets. Okay, so RM minus RF is called the market risk premium. And then when we take that market risk premium and we scale it by the beta of the stock, we're bringing the equity risk premium from a market level down to a individual stock level. Okay. Now, before we put the numbers in here and everything and try to solve the question, here's what you need to keep in mind. When we're talking about, and this is where the confusion lies, when we're talking about the equity risk premium and the market risk premium for an overall marketplace, let's say like Sweden or Finland or the United States or Canada or some other developed market, the equity risk premium beta times the return on the market minus the risk-free rate, and the market risk premium, which is the return on the market minus the risk-free rate, are going to be the same, because the assumption is that the beta is equal to 1 when we're dealing with a developed market. But what about an undeveloped market? Well, generally on the exam, they assume that it's going to be a developed market unless you're told otherwise. Okay, so beta times the return on the market minus the risk-free rate, and the return on the market minus the risk rate, that equity risk premium and market risk premium will be the same for a well-developed market index, because again, the beta is equal to 1. However, in the example that I just gave you, okay, let's say the beta of the individual stock is 1.3, okay, and the equity risk premium that you're told for that country, Sweden, let's say, is 4.82%, and the risk-free rate is 4.25%, your answer to that question should be B, 10.52%. How do we get that? Well, we take the risk-free rate, which you were told is 4.25%, and then we're going to add to that the equity risk premium, the beta of the stock times the return on the market minus the risk-free rate. Now, you were already told that the equity risk premium for Sweden, the well-developed country, is 4.82%. So whether it's beta of the market times RM minus RF or just RM minus RF, it's going to be the same because the beta of a market index, of a well-developed market index, is 1. So basically the RM minus RF is 4.82% on a market level, in this case Switzerland. And then since we're bringing this down to an individual stock level, we're going to multiply by the beta of the stock, which I told you is 1.3. So 1.3 times the market risk premium, which is the same as the equity risk premium for the index, of 4.82. We're going to take the product of those two, add the risk-free rate of 4.25%, and you will get B, 10.52%. You could check me on the math. Hopefully I'm right. I think I am. But the point I'm trying to make here is that the equity risk premium and the market risk premium for an actual market index is the same. But the equity risk premium and the market risk premium for an individual stock is totally different because you are scaling the market risk premium by the beta of the stock, and the beta of the stock is generally not going to be equal to 1. Okay. Now, on the exam, what they're also going to do is they're going to give you a whole bunch of information. They'll give you the equity risk premium of Sweden. They'll give you the beta or the equity beta of the stock. They'll give you the interest rate or the coupon rate on the bond. They'll give you the risk-free rate. They'll give you the number of times per year that it pays interest. It'll give you the credit rating of the bonds. It'll give you a whole bunch of information that you may not even have to use. So you should be prepared for those kinds of things on especially a level 1 exam. And very clearly understand that the equity risk premium and the market risk premium for a market, for an overall market, like let's say Sweden or whatever, Finland or the United States, is the same, but the equity risk premium and the market risk premium for an individual security is not the same because usually the beta will be different or differ from 1. Hope that helps you out a little bit understanding the differences. If you have any questions, you can reach out to me. You could either post a comment if you like, or you could just check out my website at chalkandboard.org. That's CHALK and AND board, BOARD, chalkandboard.org, and drop me a line there, or you can, my phone number is there. You can also text me a message. Happy to help you out. But these are the kinds of things you've got to make sure that you know solid when you're walking into that exam. You need to know the capital asset pricing model formula. You need to know the difference between the equity risk premium and the market risk premium for an individual stock and for a market index. And you need to know overall the components, and to also know, which I didn't point out, that the risk-free rate is subtracted from that return on the market to come up with the market risk premium, okay? So sometimes you'll have to back out the risk-free rate on the exam too, given the market risk premium and given the return on the market index. Okay, that's it for now. Hope that was helpful. Have a great day and look forward to working with you soon. Bye-bye.